If you're trying to follow the financial headlines right now, mid-2025, wow.
It can feel like drinking from a fire hose, can it?
It really can. Between interest rates, market swings, politics, it's a lot.
Yeah, overwhelming is probably the word.
Definitely. And a lot of people feel like they need, a crystal ball just to figure out what's actually hitting their wallet.
Right. But the good news is the signals are out there.
They are, if you know where to look and how to interpret them.
And that's exactly what we're doing today. This is our deep dive into the 2025 financial outlook, risks and opportunities for Americans.
Yep. We've gone through a pretty detailed analysis, pulled out the key trends, the signals.
All across the U.S. financial landscape. And this is really for everyone listening, whether you're just starting to invest or, deep into retirement planning.
Our goal is pretty simple. Cut through that noise for you. We're going to unpack 5 really impactful financial stories.
Explore what they mean for your money specifically. Exactly. Pinpoint opportunities, look at the risks, and give you some actual strategies, things you can do to protect your wealth, maybe even grow it.
Think of it as your shortcut to getting informed without getting totally overwhelmed.
That's the plan.
All right, let's dive in. First up, the big one, the Federal Reserve. It affects almost everything, right? And right now, they're under a lot of political pressure.
Mm-hmm. Significant pressure. And that directly impacts interest rates, market stability. The whole system feels it.
So when you look at the Fed right now, what's the biggest ripple effect you're seeing, the most immediate thing?
Well, a key thing our sources point to is this rising political chatter around the Fed's independence. Jamie Dimon, CEO of JPMorgan Chase, he actually warned about this.
Right, specifically about criticism from former President Trump aimed at Jerome Powell, the Fed chair.
Exactly. And this analysis we reviewed calls it political heat.
Yeah.
It just creates instability, especially when the Fed's trying this delicate balancing act, controlling inflation without tanking the economy.
So it's not just what they do, but the perception around it.
Precisely. The perception of political meddling, even if it's just talk, can shake confidence. It adds this sort of risk premium to markets that feels more prominent now.
That's interesting. Okay, so bring it down to the listener. How does this actually translate for your everyday finances?
Okay, generally speaking, it means interest rates are staying higher for longer. That phrase keeps coming up.
Which means?
Higher borrowing costs. Mortgages, car loans, your credit card balances, it all costs more to carry that debt.
And the stock market.
More volatility, probably. When there are questions about the Fed's independence, markets get nervous. You see bigger swings.
Okay, so given this higher rate, maybe more volatile environment, what's the smart move? What's the strategy?
The guidance seems pretty clear. Avoid variable rate loans if you can. Lock in fixed rates.
So if you're refinancing a mortgage or maybe buying a car,
lock it in. Get that fixed rate. It gives you predictability for that cost, which is really valuable when other things feel uncertain. Secure your costs.
Makes sense. Okay, from big institutions like the Fed, let's pivot to something newer, more innovative, maybe even challenging those old structures. Digital dollars, specifically stablecoins.
Ah, yes. The quiet rise of stablecoins is an intriguing development.
For listeners who might still be unsure, what exactly are they? Break it down.
Sure. So stablecoins are a type of cryptocurrency. But unlike Bitcoin or others that fluctuate wildly, these are designed to hold a stable value.
How?
Usually they're pegged 1-to-1 to a regular currency, most often the US dollar. So one stablecoin is supposed to equal $1.
Okay, and you said they're on the rise.
Quietly, yeah.
Yeah.
They're gaining traction. And there's this interesting potential upside. Some analysts think their growing use could actually strengthen the dollar's dominance globally.
But there are risks too, right? You mentioned challenges.
Absolutely. The big concern is regulation. Without strong rules, you've got risks around consumer protection, like is the money really backing the coin? And even broader financial stability if these things get really big. It's a bit of a tightrope.
I can see that. So what's the real world impact? How are people actually, using them today?
We're seeing some people explore the regulated ones, like USDC is a big example. It's backed by audited dollar reserves.
And why would they use something like USDC?
Couple of reasons. Maybe to earn better yields than they can get in a standard savings account right now, or for easier and cheaper international money transfers.
Interesting. And for others?
For some, it's becoming a small piece of a diversified portfolio, especially if traditional banks keep savings rates low. It's another potential avenue.
Okay, so if someone listening is thinking, maybe I should look into this, what's the key advice? How do you do it safely?
The number one thing is transparency. Stick to stablecoins that are fully transparent about their reserves and get regular audits. Make sure they actually hold the dollars they claim to.
And where would you typically find those?
Established platforms are generally safer. Think Coinbase, Gemini, places with strong compliance track records.
And what should you avoid?
Definitely avoid the obscure ones promising crazy high yields. If it sounds too good to be true in crypto, it almost certainly is. High yield usually means very high risk.
Good advice. Okay, so from the digital frontier, let's come back to Earth specifically, to two huge physical markets seeing major shifts: housing and electric vehicles. These affect so many people directly. Let's start with housing. What's the picture right now?
Well, the big story, according to Moody's analysis, is high mortgage rates. They've been stuck around 7%, give or take.
And that's putting the brakes on things.
Significantly slowing the market, yeah. What's really striking is their projection for some cities that were red hot just a year or two ago, places like Miami, Dallas.
What are they projecting?
Price drops,
Where?
over 5% by early 2026. That's a noticeable correction from the peak.
Wow, okay. A 5% drop is significant. So for you listening, how does this play out if you're trying to buy or if you're trying to sell?
It's different depending on which side you're on, right? For first-time buyers, this could actually be good news.
How so?
It might mean more houses finally coming onto the market, more inventory, and potentially more room to negotiate on price, less competition.
But for sellers?
It's tougher. You need to be prepared for your house to sit on the market longer. And you might get offers that are lower than you'd hoped for, especially compared to the frenzy the last couple of years.
Those days of multiple bids way over asking price seem to be fading in many areas.
For now, yes. Largely behind us in a lot of markets.
So, given all that, what's a smart strategy? What should someone do in this housing market?
Well, if you're in one of those really overheated markets, the analysis suggests maybe consider renting a bit longer. Use that time to really aggressively save up a bigger down payment.
And if you're looking to buy, are there areas that look more promising?
The analysis did point to a few areas potentially offering better long-term value and more affordability right now. Pittsburgh, Detroit, and Buffalo were mentioned specifically, places to maybe keep an eye on.
Interesting. Okay, let's shift gears now to that other big market in transition. Electric vehicles, EVs, we've seen some policy whiplash there too.
Yeah, big time. A really interesting aspect is how directly policy changes hit sales. The elimination of that $7,500 federal tax credit for EVs,
That was a big deal.
huge. It directly led to a 6.3% drop in EV sales in the second quarter of 2025. That's a sharp fall.
And who felt that most?
Companies like Tesla definitely took a hit. But interestingly, some traditional automakers like GM actually managed to pick up some market share during that period.
So what does this mean for you, the listener, whether you're investing in car stocks, thinking about buying a car, or just watching the industry?
Well, first, expect EV stocks to stay volatile for a bit. The market's still adjusting to these policy changes and demand shifts.
What else?
You might see the rollout of charging stations slow down somewhat. If sales dip, the urgency might lessen for some infrastructure players.
And what about regular gas cars?
Here's an interesting side effect. Their resale values might actually hold up better or longer than people were expecting a year ago. If the EV transition slows, demand for reliable used gas cars could remain strong.
Okay. For investors specifically, if they're looking at this EV space, but maybe wary of the car makers themselves right now, what's the advice?
Yeah, it's smart to zoom out a bit. Look beyond just the companies building the cars.
Like what?
Consider the supporting players. Companies involved in building out the charging infrastructure that still needs to happen long term. Or EV battery manufacturers.
Raw materials, too.
Exactly. Even raw material producers like copper companies. Copper is absolutely essential for EV tech, batteries, wiring, charging stations. So those foundational elements might offer a more resilient investment path right now.
Makes sense looking at the whole ecosystem. Okay, let's move on to something that hits absolutely everyone's budget: inflation. And layered on top of that, this talk of potential new tariffs. What's the latest there?
Markets are definitely on edge about this. Everyone's waiting for the next batch of inflation data.
And the tariff talk.
Yeah, there have been hints from the Trump camp about potential major new tariffs on imported goods. Economists are warning this could mean prices for a lot of things go up, and maybe pretty quickly.
So break that down. Real-world implications for your wallet.
We're talking potential price hikes on, well, lots of things we buy regularly. Groceries, electronics, clothes, anything imported could get more expensive.
Beyond consumer prices.
Yeah. Tariffs can also cause supply chain headaches again. That could hit small businesses particularly hard. And then there's the Fed angle again.
How so?
If tariffs push inflation higher, the Fed might feel forced to delay any interest rate cuts they were planning, which means that pain for borrowers we talked about, it gets prolonged.
Ugh, okay. That's a lot to brace for. What can listeners do now? Any proactive steps to prepare?
Well, one practical suggestion from the analysis is pretty straightforward. Consider stocking up a bit on non-perishable essentials now, before potential price hikes kick in. Just the basics.
And from an investment perspective?
It might be worth looking at companies that could actually benefit from this environment.
Mm-hmm.
Think U.S.-based manufacturers who compete with imports, or maybe domestic agriculture stocks. These could potentially act as a hedge if import costs rise significantly.
Okay, hedging your bets. That makes sense. All right, this brings us to our final segment. Let's try to pull it all together, projecting forward, how to navigate the rest of 2025. We've covered a lot.
We have. So let's summarize. What are the key challenges and opportunities we see on the horizon, say, for the next 6 to 12 months?
Okay, let's start with challenges. What stands out?
Well, continued inflation pressure seems likely, especially for things like food and housing, those sticky categories.
Okay, what else?
Interest rates staying elevated, that keeps the cost of borrowing high. Then there's the political uncertainty around the election season that almost always brings some market swings.
Right.
And finally, maybe some reduced consumer confidence, particularly among lower-income households, which could dampen overall economic activity a bit.
Okay, those are the headwinds, but it's not all bad news, right? What about opportunities?
Definitely not all bad. There are real opportunities emerging, too. We mentioned housing. You can see more affordable options pop up in those previously overheated markets later this year or early next.
Okay, what else?
EVs and green infrastructure, as that market corrects, you might find some discounted stocks or related plays that look attractive for the long term.
And for savers?
High-yield savings accounts and CDs should remain attractive. Banks are still competing for deposits, so you can likely still find good rates there.
Good point. Anything for stock investors?
Yeah, for long-term investors, quality companies that pay dividends are starting to look appealing again at current prices. They can offer some stability in income.
Okay, so that's the landscape challenges and opportunities. Now, the big question, what's the strategic playbook? How do you navigate this? What are the actionable steps?
All right, step one, maybe the most crucial, build or bolster your cash cushion, an emergency fund.
How much are we talking?
Aim for 3 to 6 months of essential living expenses. In this kind of uncertain environment, cash isn't just for emergencies. It's also dry powder. It gives you the flexibility to act when opportunities arise, like during market dips.
Where should you keep that cash?
A portion in an easily accessible high-yield savings account. But if you have a larger cushion, maybe look at short-term, safe options like money market funds or even treasury bills to get a slightly better return and fight inflation a bit.
Okay, cash cushion first. What's next? Especially for people who haven't started investing yet.
Just start, even small amounts. Seriously. Platforms like Fidelity, Vanguard, SoFi, they make it super easy now with fractional shares.
Meaning you don't have to buy a whole expensive share?
Exactly. You can buy just a slice. Makes it way more accessible. Focus on low-fee index funds to start something like VOO, which tracks the S&P 500, or VTI for the total U.S. market. Keep it simple, keep costs low.
Back to basics too, right? Budgeting.
Absolutely critical. Track your budget closely. Use a free app like Rocket Money or Mint, whatever works for you. See where your money's actually going. Small leaks really can sink big ships, financially speaking.
And what about debt in this environment?
Avoid new debt, if possible, especially high-interest consumer debt, like credit cards. Stay lean on borrowing.
Unless
Unless it's potentially for an appreciating asset, maybe education that boosts your earning power, or carefully considered property.
Right.
But definitely prioritize paying down any existing high-interest debt first.
Makes sense. What else?
Diversify your income if you can.
Yeah.
Explore side hustles, look for remote gigs, maybe learn some in-demand skills, AI, design, coding, whatever fits your interests. That extra income provides huge flexibility.
And staying informed. We're doing this deep dive, but ongoing learning is key.
Totally. Fundamental. Subscribe to good newsletters, Morning Brew, The Hustle, things like that. Follow reputable finance folks on YouTube or listen to podcasts. Knowledge is power, especially with money.
Last point on strategy.
Invest in yourself. Don't underestimate this. Taking courses, getting certifications, maybe even working with a financial coach. These can have massive long-term payoffs for your earning potential and your financial confidence.
Okay, great advice. So let's recap this whole deep dive into 2025. The big message seems to be, this isn't a year for just coasting or expecting automatic wealth.
No, not at all. It's really a year for strategic positioning, for being intentional with your financial decisions.
And if you're feeling a bit stressed by all the uncertainty we've talked about,
Remember this. The people who usually come out stronger during times like these, they aren't always the highest earners.
who are they then?
They're the ones with the best strategies, the ones who stay flexible, the ones willing to learn and adapt to whatever the economy throws at them.
So as you finish listening and go about your day, we want to leave you with a few questions, things to really think about and maybe act on.
Yeah, first, what is one area, just one, of your finances that you can improve today? Like right now.
Second, are the habits you're building helping you grow financially, regardless of who's in the White House or what the scary headlines say?
And finally, where can you cut through all the noise, all the chatter, and just focus on taking action? What's the next concrete step for you?
Because ultimately, your financial future isn't really built in the headlines, is it?
Not at all. It's built in the choices you make every day. So keep learning, stay flexible, keep investing in yourself. You got this.